So index fund, that's actually something I avoid ever since I started investing. So in this video, I just want to say and tell you about the 3 main reasons why I avoid investing in index fund. So when you're investing in a market, generally you can expect around 6 to 7% return, especially when you're investing in an ETF fund, index fund, or mutual fund. S&P 500 goes up on average around 7% a year, and index fund charges around 1% in management fee. So that means you get a net 6% return, or a little bit lower if it has a mixture of bonds and real estate as well. So why I avoid investing in index fund. Now, when you're looking at index fund, it is actually a very passive investment, and all you really do is you just contribute money to it, and then you get either pay on a regular basis or the fund itself goes up. So it depends if you're investing in a dividend focused fund or a capital gain focused fund, a growth fund in that case. But what I really don't like about index funds is that I don't get to control exactly which stock I want to buy. Because when you're looking at the market in NASDAQ, New York Stock Exchange, and Toronto Stock Exchange, there's over 4,000 stocks. And there are some good, some bad, and some absolutely horrible. And I want to focus my portfolio on only a few great companies that will grow year after year, and I can buy them on a discount. When I'm investing in ETF funds or index fund, I don't really get to do that because I'll be investing in 100, 500, or even 2,000 companies in the market. So that means I get the best companies in my portfolio, but I also get the worst companies in my portfolio. So that is all about control. The second one is timing. If you look at the market, you can buy any day, any hour, any minute, any second that you want. And when you're investing in an index fund, let's say on a monthly basis, your money is kind of putting into the market on a monthly basis because ETF funds, when they receive your money, chances are they'll just put it into use right away. So then they can start generating profit for you. Now, that leaves out the question of timing. And this is a big question because a lot of people believe you cannot time the market. A lot of people believe that there's no point in timing the market because a lot of studies have been done that you shouldn't time the market, so on and so forth, and nobody can truly predict the market. And that's why they go buy ETF funds. And if that is you, I think that is totally valid. If you cannot time the market, then just don't try. But for myself, I know I have a certain degree of confidence that I can buy stocks at a discount. Usually I can get stocks for 10%, 20%, or even 30% discounts or more. And by getting into stocks cheap, kind of similar to Warren Buffett, then I have a higher margin of safety. I better protect my portfolio from further crash, and I'm in a much better position when the markets start going up again. And what does that require? It requires timing. It requires a certain level of foresight. It requires me to understand the company I'm investing in, and it requires patience. So that is more active investing than just investing in an index fund, but then the reward for being patient is tremendous. And finally, the third one is really leverage. Now, when you're investing in an index fund, you don't get any leverage and you're getting a 6% return. Now, let's say you're going to buy a real estate property and you're using a mortgage, that gives you leverage. So that means when the market goes up, you get the capital gain on the real estate property. And that is very powerful if it is compounded over the next 5 to 10 years. And that's why there's so many millionaires are made because of real estate alone. It's because of the mortgage, and they rent it out and they get someone to pay for the mortgage itself. So when you are investing in an index fund, you really can't do that. You can't get a mortgage to invest in an index fund, even though some people do. But that's not necessarily a good strategy. And if you go on YouTube, you'll find a lot of people recommend against using leverage, which is probably one of the key profit multiplier when it comes to investing. So leverage is the reason why I don't invest in an index fund. So for my own personal investing strategy, I do have an element of leverage in there. So then, for example, if the stock goes up by 10%, I can expect a 20% increase for my portfolio. And I can just use real estate as an example. So let's say you're buying a house for $100 and you use a mortgage and you put 20% down. So that means you only put $20 down and the mortgage is $80. So imagine the house went up from $100 to $120. What is your gain? Your gain is $20, but you only put in $20. So that means your percentage gain is 100%. And I think that is very powerful, and that's probably the quickest, quote unquote, way to generate wealth. And that's why so many people invest in real estate. That's why so many people uses a mortgage to kind of leverage, because they can get a hold of a big asset, and when it appreciates over time, then you are in the green by a lot. So if I have to choose between investing in real estate with leverage versus a regular ETF fund, I would choose real estate with leverage every single time because the return is simply so much higher. And that's kind of what I do for stock investing. And that's why I target 30% in the market. So my name is Eric Seto, and my mission is really to help people without a financial background to learn investing and target 30% a year from the stock market. So this is done through an online coaching program called Investing Accelerator. And you can learn more by clicking the first link below, called the free case study, How to Get 30% from the Market. So this is quite a long webinar, and you will learn, what is the average return you should expect in the market? What you should do if you want to get a higher return? What are the common mistakes that investors make when they're investing in the market? And what you can do to avoid it? And what are some of the tools I use to invest in the market? And what are some of the indicators I use to invest in the market? So I've packed a lot of value in this webinar, and you'll also learn more about the program Investing Accelerator as well. So click the first link below and you can register for this free webinar.